Hello everyone, welcome to the market opening bell for Tuesday, March 10th, your 10-minute guide to the stock market. Tensions in the Middle East have escalated, with several Gulf oil producing countries announcing production cuts. International oil prices have surged past $100 per barrel as a result, putting pressure on peripheral stock markets and dragging Hong Kong stocks lower in tandem. The Hang Seng Index opened down 681 points, at one stage plunging as much as 851 points to an intraday low of 24,906 before closing 348 points or 1.4% lower at 25,408. The H-share index fell 46 points, or 0.5%, to close at 8,581, while the Hang Seng Tech Index edged down just 5 points, or 0.12%, to 4,941. Total market turnover reached HK dollar 392.3 billion. Southbound funds poured a record net 37.213 billion Hong Kong dollars into Hong Kong stocks in a single day, the highest daily net inflow on record. Among the heavy buying were 12.57 billion in the Tracker Fund, 5.324 billion in the Hang Seng China Enterprises Index ETF, 4.13 billion in the CSOP Hang Seng Tech Index ETF, 2.105 billion in CNOOC, 1.666 billion in Tencent Holdings, 634 million in Xiaomi Group W, and 322 million in SMIC. On the sell side, net outflows included 648 million from Sinopec and 295 million from Yangtze Optical Fiber and Cable. Statistics show that southbound funds have now net bought Tencent for 7 straight days, accumulating a total of 10.891 billion Hong Kong dollars. The three major A-share indices opened sharply lower but narrowed their losses noticeably in the afternoon, with Shanghai and Shenzhen turnover jumping to nearly 2.65 trillion yuan compared with the previous session. The Shanghai Composite opened at 4,098 points, down 0.6% or 25 points, and closed at 4,096 points, down 27 points or 0.7%. The Shenzhen Component Index opened at 13,920 points, down 252 points or 1.8%, and closed at 14,064 points, down 105 points or 0.7%. The Chinex Index opened at 3,152 points, down 76 points or 2.4%, and closed at 3,208 points, down 20 points or 0.6%. The renminbi central parity rate against the US dollar was fixed at 6.9158, 133 points weaker than the previous day. China's February Consumer Price Index for residents rose 1% month-on-month, the highest reading in nearly 2 years, mainly because of concentrated release of consumption demand during the extended Chinese New Year holiday. The core CPI, excluding food and energy, climbed 1.8% year-on-year. The National Producer Price Index for industrial producers fell 0.9% year-on-year in February, narrower than the market expected, 1.1% drop and 0.5 percentage point tighter than the previous month. On a monthly basis, it rose 0.4%, the same pace as January. Purchase prices for industrial producers declined 0.7% year-on-year, narrowing the drop by 0.7 percentage point from the prior month, while rising 0.7% month-on-month, an acceleration of 0.2 percentage point. For the first 2 months of the year combined, the producer price index averaged 1.2% lower than a year earlier, while purchase prices averaged 1.1% lower. Oil stocks rose on the back of higher crude prices, with PetroChina up 2.3% and CNOOC up 3.3%, although Sinopec fell 4.4%. Among oil equipment names, Shandong Molong surged 25% after the company issued a notice warning that its share price had deviated 52.37% higher over 5 consecutive trading days from March 2 to the 6th of March 2026, raising risks of market overheating and irrational speculation. The company said its production and operations remain normal and that short-term fluctuations in international crude prices have yet to deliver any material benefit to its performance. With oil prices spiking, coal prices jumped to their highest level since November 2024. The Asian benchmark Newcastle coal futures soared as much as 9.3% at one point to $150 per ton. Coal stocks were also chased higher, with China Shenhua and Yanzhou Energy both rising more than 3% and Yancoal Australia climbing over 8%. Escalating Middle East tensions pushed aluminium prices to a near 4-year high. The London Metal Exchange aluminium contract rose as much as 1.6% to $3,499.5 per ton, the highest since April 2022. Gulf War-related disruptions have halted aluminium shipments, forcing at least two major smelters in the region to suspend supply. The Middle East accounts for roughly 9% of global aluminium output, and U.S. metal buyers are now scrambling to source alternative supplies from Asia. The OpenClaw frenzy ignited artificial intelligence stocks, lifting GPU and in silico medicine by 8.1% and 7.1% respectively. Minimax jumped 23.8% and briefly touched the 1,000 yuan level. On the news front, Shenzhen's Longgang district and Wuxi's high-tech zone have either announced or are preparing supportive measures for the development of OpenClaw, the globally renowned open-source project nicknamed Little Crayfish by netizens. Minimax yesterday unveiled two new capabilities, Voice Maker and Music Maker. Built on deep integration of Minimax Speech 2.8 voice technology and Music 2.5 plus music models, users can now give their AI assistants customized voices and multi-language dubbing through the OpenClaw platform or Minimax's MaxClaw. They can also create complete songs and vocal demo hums. The functions have already gone live on ClawHub and can be used directly on IM platforms such as Feishu, Enterprise, WeChat, and DingTalk. Aviation stocks, which are sensitive to fuel costs, came under pressure. Cathay Pacific fell 5.1%, while China Eastern and Air China dropped 2.9% and 3.7% respectively. Fuel accounts for 30 to 40% of an airline's total cost and is the largest fixed expense. Analysts estimate that every $1 rise in Brent crude trims annual profit at the big three carriers by 360 million to 430 million yuan. In addition, all flights between mainland China and Iran have been cancelled, while flights to and from the UAE were cut by about 40 more than last month. Between March 2 and 8 alone, over 13,000 Middle East-related flights were cancelled, a cancellation rate of roughly 17.4%. Inflation concerns have dampened rate cut expectations and weighed on local property stocks. Sun Hung Kai Properties, Henderson Land, and Swire Properties each fell between 3.6% and 4.1%, while Hang Lung Properties dropped 4.9%. However, some investment banks have issued reports reassessing Hong Kong real estate stocks in light of heightened global uncertainty. They argue that Hong Kong may attract capital and talent outflows from the Middle East, which would support housing demand and rents. Moreover, if local inflation accelerates faster than nominal interest rate adjustments, though this pressure could be eased by importing more lower-priced goods from mainland China, Hong Kong's real interest rates could fall, given limited and inelastic land supply that would provide underlying support for property prices. The newly listed stock Meiji Smart Technology, which will begin trading today, closed at HK dollar 28.9 inches. Yesterday's gray market trading on Philip Mart 0.1% or HK dollar 0.04 above its offer price. Excluding fees, each bought lot of 100 shares would have yielded a paper profit of HK dollar 4. From a technical perspective, the Hang Seng Index once again broke below the 25,000 level and the 250-day moving average, hitting a stage low of 24,906 points. However, the 9-day relative strength index is showing positive divergence at the bottom, and the 250-day line was ultimately regained, signaling a potential bottoming process. The index is expected to hold the 250-day average in the short term and stage a rebound, with initial resistance seen at 25,800 points. Trump said the Iran war is about to end, sending oil prices on a wild ride. New York crude futures briefly spiked near US dollar 120 before reversing and falling 5% to the US dollar 86 level after the close. US stocks opened lower but climbed steadily through the session, with all three major indices finishing in the green. The fear gauge VIX index surged as high as 35 before easing 4 points, or 13.5%, to 25.5. The Dow Jones Industrial Average opened 130 points down, at one point fell more than 886 points, then staged a strong recovery with a total intraday swing of 1,260 points, closing at 47,740 points, up 239 points or 0.5%. The S&P 500 rose 55 points or 0.8% to 6,795, while the Nasdaq gained 308 points or 1.4% to 22,695. The Nasdaq China Golden Dragon Index, tracking Chinese concept stocks, climbed 122 points, or 1.8%, to close at 7,083. Semiconductor names advanced, with Broadcom rising more than 4%, Micron and AMD up around 0.5% each, and Nvidia gaining more than 2%. Alphabet also rose over 2%. Oil and defense stocks closed lower against the broader market trend, with ExxonMobil, Chevron, and Lockheed Martin all declining. Airline shares fell sharply in early trading but later rebounded, with United Airlines, Delta Airlines, and American Airlines each up more than 2%. Trump's claim that the Iran war is nearing its end triggered the sharp reversal in oil prices, while gold and US Treasury yields also retreated. Military analysts, however, believe the statement currently looks more like psychological warfare or an attempt to reassure voters. Although Iran's conventional naval and air forces have suffered heavy damage, as long as ground resistance continues and the new regime refuses the demanded unconditional surrender, the war is unlikely to truly end completely within days. Financial markets are therefore expected to remain volatile and chaotic in the short term. Biocytogen 2315. Biocytogen recently released a positive profit alert, expecting 2025 operating revenue to reach approximately RMB 1.379 billion, representing a year-on-year increase of 40.63%. Net profit attributable to shareholders is projected at RMB 173 million, marking a substantial year-on-year surge of 416.37%. This strong performance is primarily driven by the continued expansion of overseas markets, coupled with the recovery and warming of the domestic biopharmaceutical industry, which has fueled rapid revenue growth. In addition, the group remains committed to its strategy of innovation-driven performance growth. Through sustained high-intensity R&D investment, it has built robust core technological barriers, enabling the business to maintain stable high gross profit margins While lean management practices have continuously improved operational efficiency and accelerated the enhancement of profitability, Biocytogen is a global biotechnology company dedicated to the research and development of novel antibody drugs and the provision of preclinical research services. Based on gene editing technology, it utilizes its proprietary randomized platform to discover fully human antibodies and has established the 1,000 mice 10,000 antibodies technology platform. Targeting more than 1,000 different targets, the company has created a library of over 1 million fully human antibody sequences for global partnerships. Its sub-brand BioMice-TM currently offers several thousand ready-made animal and cell models, while also providing global clients with preclinical pharmacology, efficacy studies, and gene editing services. Headquartered in Beijing, the group has branch offices in China, Jiangsu Haimen and Shanghai, the United States, Boston, San Francisco, and San Diego, Germany, Heidelberg, and other locations. Biocytogen has secured multiple out-licensing collaborations for its clinical stage antibody molecules. In the first half of 2025, the company newly signed approximately 80 contracts, representing about 60% growth compared with the same period in 2024. As of 30 June 2025, it had cumulatively signed around 280 cooperation, licensing, or transfer agreements for therapeutic antibodies and various clinical assets. It has also entered into randomized platform licensing and development partnerships with multiple multinational pharmaceutical companies, MNCs, and other collaborators. In February 2026, the group licensed its B7H3 PTK7 ADC candidate IDE034 to IDEAI. Following the enrollment of the first patient in the phase 1 clinical trial, IDEA will pay the group a $5 million milestone payment, with the total potential value of the collaboration reaching up to $406.5 million. As the number of licensed projects continues to increase and clinical progress advances, the performance elasticity of the antibody development business is expected to accelerate, unlocking substantial long-term growth potential. Recommended entry price is HK$50.5 with a target price of HK$56 and a stop loss at HK$48